Welcome to our channel, Stock Market Analyst. Today, we're diving into the basics of how interest rates impact the stock market. By the end of this video, you'll have a clear understanding of what interest rates are, how they affect the stock market, and how you can use this knowledge to make informed investment decisions. Don't forget to like, subscribe, and hit the bell icon for more investing tips. What are interest rates? Let's start with the basics. Interest rates are the cost of borrowing money. They are set by central banks, such as the Federal Reserve in the United States, and influence the rates that banks charge each other for loans. Interest rates affect everything from mortgages and car loans to savings accounts and credit cards. How do interest rates affect the economy? Interest rates play a crucial role in the economy. When interest rates are low, borrowing money is cheaper, which encourages spending and investment. This can lead to economic growth. Conversely, when interest rates are high, borrowing money is more expensive, which can slow down spending and investment, potentially leading to a slowdown in economic growth. How do interest rates impact the stock market? Interest rates have a significant impact on the stock market. 1. Cost of borrowing. When interest rates are low, companies can borrow money at lower costs to invest in growth and expansion. This can lead to higher profits and increased stock prices. Conversely, when interest rates are high, borrowing costs increase, which can reduce profits and lead to lower stock prices. 2. Consumer spending. Low interest rates make borrowing cheaper for consumers, leading to increased spending on goods and services. This can boost company revenues and stock prices. High interest rates can have the opposite effect, reducing consumer spending and impacting company revenues. 3. Investment alternatives. When interest rates are low, bonds and savings accounts offer lower returns, making stocks more attractive to investors. This can drive up stock prices. When interest rates are high, bonds and savings accounts offer higher returns, making them more attractive compared to stocks, which can lead to lower stock prices. 4. Inflation. Interest rates are often used to control inflation. When inflation is high, central banks may raise interest rates to cool down the economy. High inflation can erode the value of future cash flows, impacting stock valuations. Practical example. Let's look at a practical example. Suppose the Federal Reserve announces a cut in interest rates. This makes borrowing cheaper for companies and consumers. As a result, companies may invest more in growth, and consumers may spend more on goods and services. This increased economic activity can boost company revenues and profits, leading to higher stock prices. Conversely, if the Federal Reserve announces an increase in interest rates, borrowing becomes more expensive, potentially slowing down economic activity and leading to lower stock prices. How to use interest rate information for investment decisions. Understanding how interest rates impact the stock market can help you make better investment decisions. Here's a step-by-step guide. 1. Monitor central bank announcements. Keep an eye on announcements from central banks, such as the Federal Reserve, regarding changes in interest rates. These announcements can provide insights into future market trends. 2. Analyze economic indicators. Look at economic indicators, such as GDP growth, unemployment rates, and inflation, to understand the broader economic context. These indicators can influence central bank decisions on interest rates. 3. Evaluate company financials. Consider how changes in interest rates might impact a company's borrowing costs, revenues, and profits. Companies with high levels of debt may be more sensitive to interest rate changes. 4. Diversify your portfolio. Diversify your investments across different asset classes, such as stocks, bonds, and real estate, to manage risk. Different assets may respond differently to changes in interest rates. 5. Stay informed. Keep up with market news and trends to make informed decisions. Understanding the relationship between interest rates and the stock market can help you anticipate potential market movements. Common mistakes to avoid. While understanding interest rates is crucial, there are some common mistakes to avoid. 1. Overreacting to short-term changes. Avoid making impulsive decisions based on short-term interest rate changes. Focus on long-term trends and the overall economic context. 2. Ignoring other factors. interest rates are just one factor that impacts the stock market. Consider other factors, such as company fundamentals, industry trends, and geopolitical events, in your analysis. 3. Failing to diversify. Don't put all your eggs in one basket. Diversify your portfolio to manage risk and take advantage of different market conditions. 4. Neglecting risk management. Always have a risk management strategy in place. Use tools like stop-loss orders to protect your investments from significant declines. To sum up, interest rates have a significant impact on the stock market. Low interest rates can boost borrowing, spending, and investment, leading to higher stock prices. High interest rates can have the opposite effect, reducing borrowing, spending, and investment, leading to lower stock prices. By understanding the relationship between interest rates and the stock market, you can make more informed investment decisions and manage risk effectively. That's a wrap on our guide to how interest rates impact the stock market. If you found this video helpful, please give it a thumbs up, subscribe to our channel, and share it with your friends. Have any questions or topics you'd like us to cover? Drop them in the comments below. Happy investing!